Welcome to Author's Note. This year, one of the biggest talking points in the markets has been the so-called death of equity, whereby pension funds have moved out of equities or stocks into bonds. Some fund managers say this is the biggest market allocation shift since the late 50s and 60s. With us in the studio today to discuss this trend is Alasdair Macdonald, Head of Investment Strategy at Towers Watson. Hi, Alasdair.
Hi.
Our chart shows that equities in the red became an increasingly popular asset with UK pension funds right up to a peak in the early 90s, when many pension funds were holding more than 70% in equities while only holding about 10% in bonds. However, you can see as we move into this century, the blue lines get longer until this year, in 2012, for the very first time since the late 50s and early 60s, pension funds were actually holding more bonds than equities. Alasdair, can you tell us why this trend is happening?
One of the things to recognise is that it's not just about moving into bonds. We've also diversified into other return-seeking assets. So pension funds still have more in return-seeking assets in total than they do in bonds. But I'd go back to 1995 and kind of point to two major things that have led to this de-risking. The first is that most pension funds started setting their investment strategy based on their own characteristics. And then the second was that following the dot-com crash, the characteristics of the pension funds changed. A lot of them closed to new entrants and even closed to new accrual.
So rather than calling it the death of equities, which is a hypothesis, and I stress that, is we don't know that equities have necessarily died, is it more about the death of the defined benefits pension scheme, which we are seeing fewer and fewer of, rather than the death of equities?
I think you're certainly seeing lots of private sector defined benefit schemes close to new entrants that mean, in the long run, they will disappear and be replaced with other forms of pension provision. So defined contribution funds in the UK, and indeed in Asia and the Middle East we've got sovereign wealth funds which are kind of providing pensions another way. And those institutions will be buying the equities. So it's not that in aggregate there are just fewer and fewer people out there who want to buy equities. Just one type of investor is looking to de-risk.
And you think it is just one type of investor, really, and so it's about the pension funds which are looking after defined benefit schemes, which are the ones who are moving out of equities, and this is not something typical to other types of investors, whether it's retail or institutional.
That's correct.
Does that mean that we are going to see this kind of continuing fall in equities as opposed to bonds?
I don't think it's quite as bad as you think, because a lot of pension funds have diversified out of UK equities into global equities. So I think last time I looked at the figures, UK pension funds only held about 15% of the UK equity market. So yes, they've been slowly reducing that 15%, but not at the kind of pace that you'd worry about an equity market crash tomorrow because of this de-risking activity. You know, and in the context of the global equity market, UK pension funds are a relatively small investor because this trend is not getting played out in other countries around the world.
In our second chart, we can see we've labelled it a lingering death, again a proposition of equities. The top line shows real liabilities of pension funds. The bottom line is total inflation-linked bond supply. Does the fact that liabilities, which are pension funds need to therefore need money to pay these liabilities to their pensioners, does it mean that the fact that there is a mismatch between supply of inflation-linked bonds and liabilities, does that mean that this trend is going to continue right up until 2039, you know, as pension funds still need inflation-linked bonds to make sure they can pay their pensioners?
You know, we all think we're above average drivers. We can't in aggregate be above average drivers. Our clients all think they can de-risk in 20 years' time. We did the analysis, it suggests they can't all de-risk in 20 years' time. If you look at the value of index-linked gilts they'd need to buy to de-risk, that's the top line. We look at the kind of value of index-linked gilts the government would issue and the pension funds can buy, that's the bottom line. They're going to have to wait about 30 years on average.
Thank you very much, Alasdair. In short then, the death of equities is perhaps overdone, but pension funds will still keep switching into bonds as they need these instruments to make sure they can pay their pensioners.